In this episode of Score Business TV, we're placing the spotlight on having business partners. Whether they're investors or working partners, there's little doubt your life will change when you accept a partner in your business. What are the risks and potential rewards of having a partner? What type of documentation should you have? Stay tuned as we explore the ins and outs of having business partners. Welcome to Score Business TV, sponsored by Wells Fargo. In this series, experts share their opinions with business owners and entrepreneurs on a variety of topics. So let's set the scene today. Either you're in business as a sole owner, or maybe you're planning a new business and you'd like to have one or more partners to help carry the load. Let's explore these issues with an expert. It's my pleasure to introduce Michael Zuckerman. Michael recently retired after practicing law for 54 years in New York. He graduated with a BS degree in economics from the Wharton School and a JD from Harvard Law School. His expertise is in estate planning, employment, shareholder and partnership agreements, succession planning, and the purchase and sale of businesses. Michael, welcome to the show.
Thank you.
Michael, when you're starting a business and you're taking a partner on, does it matter what type of entity you have?
Yes, it really matters. And you should understand that there are a number of different entities now that you could choose from. When I started practicing many years ago, there were only two choices. You could do a partnership or a corporation. And there was a tremendous difference between them, what I'll get into later. After that, the IRS came out and said we can allow a corporation now to be taxed as a partnership, and we'll call that an S corporation. So a corporation now took on the trappings of the taxability of a partnership, but had the protection of a corporation. Several years later, they came up with limited liability companies. And they said, okay, limited liability company is something that we're going to allow you to do, basically to elect either as to be taxed as a partnership or as a corporation. You make that election, but you get the protection that you have for the corporation without actually going through the corporation. So today, people can choose between a limited liability company, a corporation, which they can elect to have either S corporation and tax as a partnership, or straight taxation, or a partnership.
Okay.
Now, the laws are different from state to state, so the terms that I'm going to use are the ones I'm familiar with. They might be slightly different, but the concepts are all the same.
Michael, what are some of the advantages and disadvantages to each type of entity?
Well, the two main advantages and disadvantages center around liability and taxation. In liability, for example, a partnership itself, every partner is responsible and liable for all the debts of the partnership and possibly even for debts or obligations of other partners. The one exception to that would be a limited liability company, where a limited partnership, where you would have limited partners who would only be investors but would not have any liability. This is extremely rare, it's syndicated, and we'll just ignore that for purposes of this discussion. The other thing is the taxation. And in a partnership, the taxation is that the entity is not a taxable entity. It's a pass-through entity, and every income or expense goes through to the partners in the percentage that they have in the partnership. In a corporation that's taxed as a corporation, the corporation gets taxed, and then whatever it passes out, the taxation, there's a double taxation on the shareholders. There are other reasons too. For example, if you're planning on going public or becoming large, you can't be an LLC, you can't be a partnership. What you have to do is be a C corporation so that people can buy stock in the corporation. If any of your partners are foreigners, for example, you can't be an S corporation, you would have to become a limited liability company. So there's a lot of different things. I think when you choose which one you're going to go to, you really got to sit down with your accountant and your attorney and go through all the pros and cons to discuss what's the best for me, not just today, but in the long run. And I think that's because getting into one and out of another can be very expensive tax-wise. So you have to be very careful with the initial formation of the entity.
Okay. Well, I believe that, isn't it true that if you have one entity that you're in now, so many of the people watching the show will have an existing business, and maybe they have an S corp. Can they change out of that every so many years, or change one time?
I think they can change one time. I think it's a 10-year wait period, but you're left with some of the remnants of it. I'm not an accountant and don't know all the ramifications, but it's tricky, and I don't think you should be.
Okay, let's move on then.
Right.
Okay. What about choosing a partner? So let's say that I need an investor is one possible example. Another one might be someone has expertise that I don't have in an industry that I'm involved with or getting involved with. So what do I do about choosing a partner carefully so I don't have problems down the road?
Well, basically, you're entering into a marriage, a business marriage. And I think you've got to be extremely careful of who you do and who you bring in with you. In many cases, you're just looking for an investor. And this person is just going to put money in, keeps a hands-off situation. They invest in many similar type deals and give them a report once a month or once every 3 months, and they're happy as long as they're making money. But the most common is where you're going to bring in people who you want to help. You're a salesperson. You need someone in the finance. You need someone in the production part. So you look for those types of people. And very often, the ones who are good enough to bring in don't want to come in unless they have an ownership interest. Now, you've got to be careful about who you bring them in and when. For example, I handled a lot of medical practices. And a doctor coming out of residency comes into the practice. Do you make him a partner the first day that he's there? Well, we've had too many people really get burned on that. I try to go for a 2-year period. A 1-year period, a guy could hide who he really is. We had situations where a doctor came in. He was the best doctor they could imagine, but he could not handle the nurses. He couldn't handle the staff, and he had terrible relationships with the patients. And after 6 months, they said, goodbye, we don't have an ownership interest because you had a 2-year waiting period before you came on. So you've really got to be careful who you do it and how you do it.
I know instances where a business owner will want to reward loyal employees by giving them some ownership interest in their organization, whether it's an LLC or a corporation. Is there anything that you've seen over the years that's a better way of doing that so that you don't go, oh my God, I've given up too much, or this person isn't who I thought he was? Or
there are a number of ways. One is to do it with a bonus system as employment so that they could get a share of the profits at the time that they're working, but as they leave, you don't have to buy them out. You could give them phantom stock and say, we'll pretend that you have this stock, and when you do leave, we'll give you some appreciation that's based upon it. Or you could give them an option to be done at some later time. But you've got to be very careful bringing in these people. And you might want to do it on a different level. You might not want to bring them in as a full shareholder. You might want to bring them in a corporation as a non-voting shareholder or in a non-voting member in an LLC, something like that.
Obviously, when you bring in a partner, you don't want to do it on a handshake. That's not really the way to run the railroad. So what kind of documentation is necessary?
Well, it's very interesting because people come and they say, see, my partner, we went to grammar school together. We've been together for 50 years. My best friend. Well, how much business experience? Well, we never did, but we talked about it. Or I got a family member who's coming in. You know, how can I ask my brother-in-law to do this or do that? And I'll give you a perfect example. I had a client who had a very successful business. He had an unmarried daughter who was in the business, and suddenly she becomes engaged. They get married, have 2 children, and he comes to work for the business. He's great in the business. So my client comes to me and says, gee, I want to give 20% of the business to my son-in-law. I said, well, why don't you give it to your daughter because she's married? And no, he really wants it himself. I said, please don't do it yet. He's just been there for a short time. No, I really want to. I said, okay, then let's get an agreement with him that if he leaves, he has to sell it back and set the price. No, I don't want to embarrass him. I pleaded with him. No, he gave him the 20%. And 2 years later, when they come to divorce law, the divorce court, he comes to me and says, the divorce is absolutely horrible. They're just hating each other. He's refusing to give up his stock, and I can fire him, but how do I stop him from being a... I says, you can't, and you can't stop him from selling it to a competitor if a competitor wants to come in and own 20%. So he really learned his lesson. So there's nothing that's safe. You can't do it on a handshake. You've got to tie everything down. And I think further on in our discussion here, we're going to discuss the various things that should be in either the operating agreement, which is the agreement that you use in an LLC, limited liability company, or the shareholders' bylaws and employment agreements that you use in corporations, or a partnership agreement that you use in a partnership.
Okay. And each side should have their own attorneys, correct?
Well, you might even have as many as an extra attorney. I've seen people who each have their own attorney, and then they hire a third attorney who draws the documents, and then the other two comment. Because there's no way, and I've been doing it for 54 years, that I can be fair to everybody in every point. I can try to be or pretend that I am, but it's called conflict of interest. And that's one way to get disbarred.
Well, that gets expensive, having all those attorneys.
It does. So what you usually do is you try to get one lawyer who's really good in that field. Make sure you don't get your divorce lawyer or the guy who handled your real estate deal. Get some guy who's done 1,000 of these businesses, and you and then you sit down and you go through all these points, and you come out with what you think you want. Then he draws that document, and then each of your lawyers looks at it from your standpoint and says, I'd like a change here or a change there. Yes, it's expensive, but it's a lot less expensive than what I call the Lawyers Relief Act, which is when you don't have an agreement and they come to you absolutely panicked. We hate each other. How are we going to get out of this? And in fact, in SCORE today, we have our exit committee. And a number of our people coming to us are in business together. And how do we get out of this? We hate each other. We're struggling. We got this, we're that. I can do much better without it. How do I get out of it? Well, what I tell the SCORE mentors today is exit planning for partnerships starts before you go into business, not when you get into trouble.
Absolutely. So what kind of written documents do you recommend they have?
Well, for a partnership, you just need a partnership agreement. And you only really need that if you're willing to rely on the state law. Every state has a very strict partnership law that covers almost every situation. But you're not going to like the way they set it up. Obviously, it's not to your advantage. It's to some legislator who decided that this is the way it should be done. So you form a partnership agreement in which you cover all the various aspects. Who's the manager, what your titles are, who's allowed to do what you're allowed to do, how you divide your profits, and we'll get into all these different things later on.
Okay.
But particularly, you should have an exit strategy. What happens when we no longer want to or are unable to continue together?
Right. And you're on the exit strategy team at SCORE as well.
Yes.
Okay. And then we do that.
And I'd much rather do the planning in advance than do it after the fact when they don't even want to talk to each other.
Okay. So you're putting a company together and you need money. So what forms of capital, what if one partner wants to put in more than the other one doesn't have the money? How do you equalize some of those issues?
Well, there's certain types of capital that you put in. The obvious one is cash. The cash can either come from a person, it can come from borrowing, it can be put in as capital so that it stays in the corporation, or it could go in as a loan, at which point you would get it back at some point. If you do it as a loan, the chances are you're going to have trouble getting outside financing from anybody else, particularly unless you subordinate that loan. So most of the time you're going to go in with cash for capital. But very often people have equipment, they have inventory, they have the business that they had before, they have accounts receivable, they have a client list. They put those, you kind of somehow value those items as well. If an outside investor's coming in, they're going to want you to value how much equipment am I putting in and how much cash do I put in to equalize it, or are we going to be equal partners or other than equal partners? So that's a big decision that has to be made.
So if you made a loan, and what kind of an interest rate would be a fair rate?
I think you'd have to choose whatever the common rate is. You could charge a little more than a bank would charge probably, or maybe even a little less. I don't know. I would go to the accountant and say, give us a decent rate. If you fix the rate, that's one thing. If you have a floating rate, that's another. But you really have to subordinate it. And one of the biggest problems you have when you're forming this partnership with capitalizing it, people say, I've got X number of dollars, I'm going to put it all into the entity. I said, well, what are you going to live on for the next 6 months? Oh, I'll take a salary and I said, you mean you're going to put the money in and then take a salary of your own money, take it back?
Pay
So what you're doing is you're creating an income tax for yourself for using your own money. Oh, I never thought of that. So I said, make sure you keep out enough money so that you're going to be able to live without taking anything out, because you're going to need to build your inventory. You're going to have accounts receivable that don't get paid for 30, 60, 90, whatever days. So you've got to finance that. Why should you pay income tax on your own money? Oh, I never thought of that. So you got to be very careful about things like that.
Let's talk about personal guarantees. So you have leases, you have contracts. What do you guarantee? What do you expect it to guarantee? If you have anything with a bank, I'm sure you're going to guarantee it. What's coming on that?
Well, the dream when you go in is I don't have to guarantee anything. And then the money guy comes in and says, I'm going to give you this money, but I'm not going to guarantee anything. So now the question is to convince your landlord, because you got a 5-year lease or whatever, 10-year lease, and a business that has no history at all. You go to the banker, as you said, no history at all. How much money are you going to have? I'm going to have your personal guarantee, and you've got to have the assets behind it. So some guy's putting everything he has into this entity. He really doesn't have the personal guarantee, and he's going to rely on the other person. And if you're that person giving the guarantee and you're not really the one running the business, you got to think twice. That's really tough.
Well, guarantees really aren't a problem as long as everything goes well. It's when they don't go well when you have a problem. So,
exactly.
So all the partners would have to sign on the guarantee, correct?
Well, that's the ideal,
Yeah.
but all the partners are not equal. And what you try to do in the guarantee is to say, we'll sign the guarantee, but we're only responsible for our proportionate share. I'm not going to be responsible for 100% because this clown is not going to be able to come up with a nickel, and then I'm going to cover the whole thing.
Well, that's where I was going with the question. So, but let's say that exactly that happens. So something comes up, things aren't going well, it goes south, and one person says, okay, we owe 50,000, here's my 25. And he looks to the other fellow and he says, well, I don't have the 25. And, isn't the first person that did the 25 still liable?
You have to read the guarantee. If it says I'm only responsible for my proportionate share, the answer is yes. If it says I unconditionally guarantee, the answer is you're responsible. And then what we do then is cross indemnities, in which we say, okay, if you have to pay my share, I'll agree to pay you back. But that's only as good as the paper it's written on.
Absolutely. So what about salaries and draws? So two partners, and I'm keeping it simple with two, it could be three or more, two partners in a business, and they say, okay, the business is making some money, let's take money out. How should we take it out? As a draw, as a salary, as a bonus? What are the other options? And what's good and bad about the options?
Well, I think that you've got to look at the needs of the entity first. How much money you're going to need. You can't take out more than it has, because that's a sure way to bankrupt the business. So you've got to work it backwards. What we did, particularly with professional practices, I handled a lot of doctors, dentists, and they were on a cash basis. So whatever came in or went out on the last day of the fiscal year was in that year. If it was the next day, then it would be picked up in the following year. So they had to sit down about a month in advance, figure out how much was coming in, and then they would figure out bonuses and whatever. And in order to get to that position, they had a small draw. Each month or each week or whatever it was, they would take out an amount that was clearly less than they'd be entitled to. And then they'd settle up maybe every month, every quarter. Quarterly was a good way to do it, or semi-annually. And then they would have to live on that until they got to the end to see how they were going to divide it. The key here, though, is how people decide how much they're going to get. Now, I'll give you a perfect example. I had a professional practice with 4 doctors, and they decided that they would all share equally. Now, this turned out to be a disaster because doctor number 3 decided that why should I work Wednesday and Friday afternoons when I can earn the same amount and take off and do what I want to do? So suddenly he's off 2-3 days a week and getting an equal amount. So they came to me, what do we do? I said, well, we got to put in a formula. The formula is based upon what you've actually produced. But it doesn't have to be 100% of what you produce, because that's not fair either. I've got other people working for us. I might have a dentist, hygienist. I might have some kind of a nurse practitioner. So we got to figure out how we're going to share these things. And that was one of the biggest things in setting up these partnerships, was to sit down with the accountant and get the experience that other people in similar businesses had, do a real good calculation of cash flow, what you're going to need in the business, what you're going to need individually, and see if those are going to work out.
I'm going to give you an example of what I did. You tell me if this is a good example or not, or if it was a good method. What I said.
Am I representing you or your partner?
No. Well, it was in the agreement. It said that no one will draw any money or will be distributions to partners until a ratio of 2 times the amount of expenses. That money had to be in the bank. So if our expenses every month was $50,000, no one got a dime until we had at least $100,000 in the bank. Over that amount, then we'd start doing distributions.
I think it's a great idea if it could work. The problem is whether the people could afford to live without getting anything out of the business.
Well, in this instance, it worked.
But if you got 2 people starting a brand new business, they're in their 20s and they're trying to do things, and they got kids at school, whatever, they might not be able to handle that. But yeah, that's the type of thing that you really got to think about.
And that's really how profits are distributed, is what we covered. Is there anything else that we should look at as in relation?
You take a corporation that says it only gets taxed on its income. Up until last year, the corporation tax rate was quite high. Now it's quite a bit lower. But when it was high, they would sit down and try to take out the day before the year ended as much money as they could to make sure there was no profit. So they'd rather pay the tax personally than not. In fact, a couple of them would not go to the mailbox to last week to make sure that they didn't get any checks in, so they didn't take them until the following year.
Yeah. Okay. What about additional capital? When additional, they need to put more money in?
That's a huge area, because I'll tell you an interesting story. I represented, when I first started practicing years ago, people who owned a lot of land out in the area where the mines, and they had a lot of mining rights there. So they would go to the big publicly held corporations and said, listen, I will give you the right to go on this land and mine, and I get 95% and you get 5% after you've got back your expenses. Fine. So they dig around, they come back and say, we need more capital. You got 95% of it, we'll give 5%. No, I can't do that. Okay, we'll put in all of it. But now you've got 50% and we've got 50%. And 2 more draws later, he had 5% and they had 95. When they finally, believe it or not, they found gold, right? So here, you got to plan ahead for the additional capital. And if you can't put in your share, you got to be prepared to take a less of a percentage in the business or sell out. And that's another reason for an exit strategy. I need more capital. I can't afford to put it in. Fine, then I'll buy you out and I'll put it in.
Right. Or the percentages can change.
Exactly.
Yeah. So what about proper expense allocation for business expenses? What's considered proper and what isn't?
Well, again, you sit down with your accountant, but I want to have a Lamborghini and you want to have a Ford, right? And I'm X number of years old and I want to put so much in my pension plan, and you're much younger and you don't have to put as much in to end up with the same thing. I need 2 secretaries and you need 1. You got to sit down and decide. I've gone partnership agreements with doctors particularly, where 4 or 5 pages long cited each expense and how it was to be allocated, because I don't want to pay for because you have 2 nurses and I only have 1. Why should I pay for that? And your nurse has been with us for 20 years, so she's getting the highest salary. Mine has just come in and getting absolutely low. How do we balance those things? The problem comes in things like rent. We've got 2 offices. You're in one with a small little office. We pay $100 a month. I'm in the big main office that pay $1,000 a month. Do we each share equally? So you've got to go through a lot of the major expenses. How about my medicine, my medical coverage? How about my disability insurance? How about my life insurance? We'll get to these later. And my retirement plan. I don't need a retirement plan. My spouse has a very good retirement plan. I don't really need it. I do. So you have to allocate these. And very often you'll take expenses that one wants and doesn't want, and you add them in as part of their salary. So that's part of the draw. If you want medical insurance, but my spouse has their own and I don't need it, fine. But your salary then will be reduced by the amount of your premiums that we're paying.
Okay, so here's question number 2. I did something similar to that where I said, okay, we want different things. I'm a little older than you are, and so,
right.
we looked at the amount of dollars, and then we made an adjustment for any differential. So mine was 10,000 and yours was 12, so we adjusted for the two.
Right.
Does that make sense?
That makes sense. And another thing that makes sense is we'll allocate to a car X number of dollars a year. If you want to spend more than that, that's your business. You want to spend less, that's your business. I know you want to get these professional journals. I don't need them. We'll figure that out, and you can do those things. I want to go to professional meetings. Okay, there's one around the corner. You could take the trolley over there for 15 cents. Oh, no, I'm going to Hawaii where I could spend the week enjoying it's the best conference in the world. Fine, I'll allocate X number of dollars for that. So that's the way we work that.
I'm going with the Hawaii fella too. Let's look at management and control. Okay, so who decides what? You have two partners, they are equal in terms of, and that's another, let's go back one step. They're equal. Should they be equal? Should they be 50-50 or 51-49? What are the, what's your comment?
Well, if you can convince one
that?
to be a minority, that's fine. But if they're putting in equal amounts and spending equal time, then they're going to have to work out the management between them. I've done that in a number of ways. One is I actually alternated each year. January 1st, you become the president. Next January 1st, you become the president. That's one way. I don't recommend it, but it works if it works. The second way is you'll have a committee. And you're allocated, say you're in sales, so you could deal with anything in sales, inventory, and that kind of stuff. The other guy's production, he deals with that, and anything else they have to jointly agree on. Or they have a third member as a committee. I had one company, it was third generation. The grandfather had formed the company, did a great job. Left it to his two sons who were phenomenal. They ran it so well. One was the inside guy, one was the sales guy, finance guy. The production guy was great. They get older, they bring their two sons into the business. These kids couldn't decide on whether this was black or this was white. What we did was, and I hesitated to do it, but every Monday morning for breakfast, I met with the two of them with two other people. One was an accountant and one was an expert in their business. And we sat down and we said, you get together all the problems that you can't decide between yourselves and we'll discuss it and we'll settle it. And we did. And last year they sold the business.
You just took away my question number 3, which was, you kind of covered there, so I'll pass on that. But it really just had to do with area of expertise. So you have the sales expertise, and I have the general business running expertise. So if it's a sales-related question, you make that decision.
Right.
Otherwise, I make the decision, that kind of a thing.
One of the places you run into, though, is hiring and firing. We had the thing in our law firm where one person had a secretary who was absolutely the best secretary you can imagine. And the fellow, we rotated managing partners for a while. And the one guy who was managing partner this time had something against the other guy. He fires his secretary. He absolutely screamed bloody murder. He said, the secretary, you can't do that to me. And finally they reversed it, but it could be a disaster. You can, if you get into an area they don't know what you're doing and you do it, that's where the problems arise.
Okay.
But you all this set down in your agreement. If you have bylaws, for example, a corporation has bylaws, those bylaws will provide how this happens. The operating agreement for an LLC will so provide, and so will the partnership. The problem is that for outsiders, if you have a title, if you're a member of an LLC or a vice president or a president of a corporation, you are given apparent authority to bind the corporation. Mm-hmm. So you could go out and make it a position that everyone else is opposed to, but you could be bound by that because you've given the person that you're dealing with the apparent authority that this person can do that. So you've got to be very careful giving titles and authorizing what people can do.
Absolutely. If someone's an officer of the company, that
exactly
they can get you in trouble.
Yeah.
So let's talk about.
I won't give you a raise. I'll give you a title.
There you go. That's right. Yeah. Let's talk about some health issues. So let's talk about disability and death. One partner is disabled. Should you insure for that? What do you do when that happens and you didn't expect it?
There's several kinds of disability, so you've got to deal with that. You have temporary disability and you've got permanent disability, or total disability or partial disability. And you've almost got to deal separately with them. Now, you can only afford disability buyout insurance if you're a very successful company. It's quite expensive. You have to have an agreement that covers it, and they will only pay 80% of the buyout paid over a number of years, so that you can't get a lump sum payout on something like that. It's quite expensive, and you have to follow all their definitions. You have to be exactly defined as it is. So forget that disability buyout unless you're really successful and have a good business.
Let's say we'll go back a step. So when the money comes into the entity, person dies, the money comes to the entity, and they're going to buy the spouse, get the shares for the other spouse.
Right.
There's no taxable gain to the entity, correct?
Correct.
Okay.
Life insurance is received tax-free.
Right. I just wanted.
And there's no taxable gain.
I'm an insurance agent, but I wanted to make sure that was stated.
And there's no taxable gain to the spouse, because the spouse took a step up in basis, which would be equal to the sale price.
Right. Mike, what do you do when one partner wants out? They just said, I had enough. I want out.
Well, again, the agreement should have provisions, but the alternatives to that are, number one, the other partner can buy them out, and that could be over a period of time with a note or whatever, based upon future profits or something like that. If that's not acceptable, you can allow them to sell to another party if you agree to that other party. Or third, you can both agree to sell, and we have what's very often called a tag along. And that's something they really should put in. If one partner wants to sell, and they have come up with a decent offer, from a bona fide offer that's reasonable from an outside party, and they decide they want to sell, the other person then has to sell their share if they don't want to buy the other share at the same price.
So they get the option.
They get the option first to buy out, and you can even take a discount off the other price, and they only have to buy their share, or they have to both sell to that third party.
Okay. So what if one partner wants the other partner out?
Now you got a whole different situation, because that's very sticky. But again, the provisions can say, if you have three partners and two want if one wants one of them out, you got a difficult situation. If two of the three want the third one out, then you can certainly provide that a majority can always ask some to leave. And then you've got to set forth the conditions of that, the price, how it's paid, and things like that.
So in the initial partnership documents, should you delineate who you can and cannot sell to?
Yes.
Okay, so that's very, very important.
Very important.
Let's talk.
Most partners don't want to be partners with my kids or your spouse or your brother-in-law, and so they'll provide for it. Okay. Others, if it's something, just a pure passive investment like real estate, owning buildings, really doesn't matter. So it would fit the situation in that case.
Okay. Mike, let's talk about covenants not to compete. Let's talk about it from two perspectives, while the ownership continues and then after it's terminated.
The best place to put the covenant is at the time that you create the company, before you do anything. It should be in the initial agreements. And the reason for that is, I don't know the law in every state, but in New York, unless there's consideration for the covenant, it won't be enforced. It has to be reasonable, has to be over a reasonable time, a reasonable place, and it has to be for consideration. So that the consideration is for entering into the agreement and the relationship altogether. If you've already entered into that relationship, and then you say, oh, by the way, I forgot a covenant not to compete, go ahead and draw it, but I doubt whether the courts will enforce it. But to go to the court and have it enforced is expensive anyway. So again, it's a matter of who says, she says, or whatever.
Sure. And I've done that, so I know a little bit about that. But a lot of that has to do with the variables of time and geography, distance.
Exactly.
So you want, maybe it's 25 miles from the courthouse, and maybe it's, for 2 years. And once you get beyond a certain amount of years, they say, well,
exactly,
that's not necessarily reasonable. But in that covenant, wouldn't you say that you would do it to what a court would reasonably consider?
You set your limits, and then you say, by the way, if any court finds that this is too extended or too great a period of time, then we'll do with what the court says is reasonable.
Right, so you back it down. And what about...
The courts don't like to set that if they don't have to. So you're smart to keep it. You don't say, all right, I'll do it forever for the whole world, but if the court cuts it down to 3 blocks in Sarasota, we'll go with that.
Sure.
Court's not going to do that.
Yeah.
You say it's overreaching in the first place.
Right. So we're in business together. We're partners. I say, Michael, I've got another opportunity here that I'd like to get involved with, or that I am getting involved with. And I guess I couldn't possibly continue to give my best efforts, though I wouldn't tell you that, but because I'm going to be distracted. How does that go over?
Well, if you're only a cash investor, that's not a problem. That's probably allowed into the original agreement, as long as it's not a competitor that's going to come in and actually compete with you. But I think that situation is such that you'd have to get permission in any such event to go out and do that, and probably take a reduction in your percentage, because if you're devoting less time to the organization, obviously there should be something there. A way around that, and I've seen it happen, is if you're truly happy with your partner, is you say, I've got another deal, why don't we go into this together? And then there's no question about it, you'll both be doing that. If they say, no, I don't want you in my other deal, or no, I don't want to come in your other deal, then you've got to deal with it. But I don't think they should be allowed to do it without any discussion. It has to be upon agreement.
And finally, let's talk about the exiting process, which you've alluded to several times, as far as cashing out and exit strategies. Just general comments on that.
Yeah, in the buy-sell agreements, you've got to have all these things covered. Death, disability, I want to leave, you want to leave, I don't want to be your partner anymore, or you're such a bad person, or you get convicted of a felony, or you're accused of whatever, or you want to go into politics. Any number of things could cause it. And you really should list all these different things. You're never going to get every possibility.
Right.
And no agreement is going to cover every possibility. But at least you try to get 90% and provide some other way to deal with it. The biggest the biggest question you're going to have is valuation. And valuation is really sticky, and I think you've got to deal with how you're going to deal with it right at the start. Some ways that people deal with it, they say, okay, this business is worth X number of dollars. That's what we're putting in. We're going to stick with this number for a year, 2 years, and every period of time we'll come back and revisit it. And guess what?
They don't do it.
They never do it.
I know.
I've had them for 50 years, and I call them and say, we're supposed to redo it. Oh, well, we're too busy. We're having no much fun. No one's leaving. We'll do it next year.
You know what? I did it on a 3x5 index card, and honestly, and every year we'd come out and we'd look and we'd change the number, we initial it. And so, but let me ask you one final question.
The other is a formula, and the accountant will work out a formula. Very often, the business that you're in has a formula: X number of times gross, X number of times net, or what have you, or assets plus something, and you just do that formula. And every year, the accountant, when they do your tax return and your annual statement, come up with a new number, and you agree to be bound by it.
My final question is, in your opinion, in your experience, what percentage of partnerships fail?
Can we add marriages to that? Because this is nothing but a business marriage.
No, let's keep it to business.
That's hard. I can't.
Give me a range.
I would say, it depends on the relationships and what have you, but it could be as high as 50% fail. If they're a restaurant business, it's going to fail anyway, but...
Oh. Mike, do you have any additional thoughts as the show comes to a close?
I think the best advice that I can give is what we've talked about for the last period of time is so complex and so comprehensive that we can't expect people to have gotten the business. If they're going to get into a relationship, partnership, get yourself some good, competent advice right from the start and go with it. It's going to cost you a little more at the beginning, but in the end, it'll save you not only headaches, but all kinds of money. And that's my best advice. Again, talk to your SCORE people. I think that's a huge advantage because we're training them to be sure that these things happen. And I think that that's very important.
Mike, thanks for being my guest today on SCORE Business TV. You've incredibly enlightened our audience on a very common topic that happens with a lot of SCORE clients are involved with partnerships. If you'd like more information about today's show, or you'd like to inquire about having your own SCORE mentor, please reach out to us at 800-634-0245 or on our website at www.score.org. I'd like to thank Mike Zuckerman for appearing as my guest on SCORE Business TV. I'd also like to thank our sponsor, Wells Fargo. Please tune in for our next episode. Until then, this is Dennis Zink. Thank you and have a great day.